going freelance here in the UK. It's brilliant for freedom, isn't it? But the money side, especially taxes, that can feel like a completely different ballgame.
Absolutely. It's a common feeling.
That's why we really wanted to dig into tax planning specifically for freelancers today. Get some practical tips, some tricks, and actually, my tax accountant helped arrange this whole discussion. They're really well regarded, know their stuff, helping freelancers sort their taxes out.
They certainly do. They see the common issues day in, day out.
Right. So our aim today is basically to lay out what you, the freelancer listening, need to know to plan your taxes well. And maybe, just maybe, trim that tax bill down a bit.
Exactly. Because being a freelancer means you're running a business, essentially. And understanding tax isn't just, form filling once a year. It's about being smart all year round.
Making sure you're playing by the rules, but not overpaying.
Precisely. Not paying a penny more than you absolutely have to.
Okay, so let's start right at square one. For someone brand new, or even just needing a refresher, what's the very first thing tax-wise a UK freelancer needs to grapple with?
Well, the absolute must-do, the non-negotiable first step is registering as self-employed with HMRC, the tax office.
Right, HMRC. When does that kick in?
It becomes a legal requirement once your earnings from self-employment go over £1,000 in a single tax year.
£1,000, okay.
And remember, the tax year runs April 6th to April 5th. You've got until the following October 5th to get registered.
Because there's a bit of lead time.
There is, but honestly, registering early, maybe even before you hit that £1,000, it's often a good idea. It just gets you in the system, avoids any panic near the deadline.
Yeah, get ahead of it. Good tip. And how does HMRC typically see freelancers? What's the usual tax status?
For most freelancers, certainly when starting out, you're usually classed as a sole trader.
Sole trader. Okay. What does that mean in practice?
It basically means there's no legal distinction between you and your business. It's all treated as one for tax. So your business income, your expenses, they all go on your personal self-assessment tax return.
Right. So it's not like setting up a whole separate company necessarily.
Not initially, no.
Yeah.
You could operate through a limited company that's a different structure with different tax rules, but sole trader is the most common starting point.
Got it. So as a sole trader, what are the main tax jobs you've got to do?
The big ones are paying income tax on your profits.
Profit being income minus expenses.
Exactly, minus your allowable business expenses. And then there are national insurance contributions, or NICs.
Ah, yes, national insurance.
You'll typically deal with two types. Class 2 NICs, which is a flat weekly rate if your profits are over a certain amount, and Class 4 NICs, which is a percentage of your profits above another threshold.
Okay.
And the main annual task, the one everyone knows about, is filing that self-assessment tax return.
Right, the tax return itself. Now let's shift gears a bit. We know freelancers hit common roadblocks. Our sources highlighted some frequent accounting mistakes. First up, mixing personal and business money. It sounds basic, but why is it such a common pitfall?
Oh, it's incredibly tempting, especially when you're just starting. Using your personal bank account feels simpler, like one less thing to set up.
Yeah, I can see that.
But it quickly turns into a nightmare. Trying to figure out later, was this coffee for me or a client meeting, or is this software subscription business or personal? It wastes so much time.
And leads to errors, I imagine.
Big time. You risk getting your expense claims wrong, which affects your profit and tax calculation. The simplest fix, and we always strongly advise this, is open a separate business bank account right away.
Create that clear line.
Exactly. It makes tracking business income, outgoings, cash flow just so much easier. Gives you a proper view of how the business is actually doing.
Okay, makes total sense. Trying to unpick it all months later sounds awful. What's another common slip-up?
Poor record keeping. It's huge. Think about all those receipts for, I don't know, train tickets, stationery, software.
Little things that add up.
Precisely. If you lose receipts or don't record expenses properly, you can't claim tax relief on them. So you end up paying more tax than you should.
And worse.
Worse is if HMRC decides to look into your return. If your records are messy or incomplete, that can lead to questions, stress, and potentially penalties.
So the lesson is, keep everything.
Pretty much. And keep it organized. Develop a system. It doesn't have to be complex initially. A simple spreadsheet. Dedicated folders for receipts.
Or digital tools.
Yeah, digital tools are great. Accounting software like Xero, QuickBooks, Free Agent, they make logging things easy, often let you snap photos of receipts. Even just taking photos on your phone and saving them somewhere organized is way better than a shoebox full of crumpled paper.
Good habits from the start. Okay, next one. Tax deadlines. It feels like there isn't just one date to worry about, is there?
No. Definitely not. That's a common source of stress. You've got the deadline to register, and then the deadline to file your tax return, then the deadline to actually pay the tax.
And if you're VA registered,
Because you've got quarterly VAT return and payment deadlines thrown into the mix as well. It's easy to miss one if you're not on top of it.
and missing them means penalties.
Penalties and interest charges, yes, which just adds insult to injury.
So how do you stay organized with all these dates?
Simple answer.
Yeah.
Put them in your calendar. Digital calendar, wall planner, whatever works for you. Set reminders way ahead of time.
Don't leave it till the last minute.
Absolutely not.
Yeah.
The really smart move is to file your self-assessment return early. You can usually do it anytime after the tax year ends on April 5th. Get it done in the summer maybe. Gives you breathing room, avoids that January panic.
Good advice. Now this next one feels like a classic freelancer trap. Not putting money aside for tax. That first big payment hits your account. It's tempting to see it all as yours.
It really is.
Yeah.
And this catches so many people out, particularly in their first year or two. You absolutely have to remember that a chunk of every payment you receive isn't really yours. It belongs to the taxman.
So what's a safe amount to squirrel away?
A common rule of thumb is to set aside maybe 25% to 30% of your earnings, but it really depends on your income level and your personal tax situation. It could be more, could be less.
And you mentioned something, payments on account?
Yes, this is a potential surprise. If your self-assessment tax bill is over £1,000, HMRC usually asks you to make advance payments towards your next year's tax bill.
Wow, okay.
These are called payments on account. You typically pay them in 2 installments, one in January and one in July. If you haven't budgeted for that first payment on account alongside your main tax bill, it can be a real shock to your cash flow.
So saving consistently is key.
Absolutely vital. Treat it like another business expense. Set up a separate savings account and transfer a percentage every time you get paid.
Okay. What about the ups and downs of freelance income? It's rarely a smooth monthly paycheck.
Know that irregularity is part of the deal. And underestimating how important cash flow management is. That's another common issue. You might have a brilliant quarter, then things go quiet.
And you still have bills to pay.
Exactly. Rent, utilities, software subscriptions. They don't stop just because the work slows down. If you haven't planned for those leaner periods, it can get very stressful.
So how do you manage that ebb and flow?
It's about understanding your numbers. Track your income patterns, forecast realistically what might be coming in, know your regular outgoings, and try to build up a buffer, a cash reserve for those quieter times. A financial cushion makes a huge difference.
Makes sense. Thinking longer term now. Neglecting pensions. Easy to put off, right?
Very easy. When you're juggling clients and deadlines, retirement can feel a long way off. But as a freelancer, there's no employer sorting your pension. It's all down to you.
And the impact of not doing it.
Well, you could reach retirement age with very little to live on. Beyond the state pension, it really affects your long-term financial security.
So what's the advice? Just start.
Yes. Start as early as possible, even if it's small amounts. Set up a personal pension or a SIPP, a self-invested personal pension. The great thing is, you usually get tax relief on your contributions.
Ah, so it helps with tax now, too.
Exactly. For a basic rate taxpayer, every 80 pounds you put in effectively becomes 100 pounds in your pension pot because the government adds the tax relief. It reduces your taxable income for the year.
And if you run as a limited company,
Then making employer contributions directly from the company into your pension can be a very tax-efficient way to extract funds and save for retirement. Definitely worth looking into.
Okay, last mistake before we move on to allowances. IR35. Sounds complicated. What's the gist for freelancers using a limited company?
Right, IR35, or the off-payroll working rules. It's legislation designed to figure out if someone working through their own company is, for all intents and purposes, acting like an employee of their client.
So looking at the actual working relationship.
Yes. It checks things like, does the client control how you do the work? Can you send someone else to do the job instead of you, substitution? Is there an ongoing expectation of work, mutuality of obligation? If the relationship looks like employment, IR35 might apply.
And if it applies.
It generally means you'll pay income tax and national insurance, similar to an employee, which is usually higher than if you're genuinely operating outside IR35. The responsibility for determining status now often lies with the end client if they're medium or large sized.
Sounds like a tricky area.
It can be. Understanding your contracts and working practices is crucial. If you're unsure about IR35, getting professional advice is really important to make sure you're compliant.
Definitely one to be careful with. Okay, so that covers some common mistakes. Let's nail down those key obligations and allowances again. We mentioned registering by October 5th. What about the actual filing deadline for the tax return?
The main deadline for filing online is January 31st after the tax year ends. So for the 23-24 tax year ending April 5th, 2024, the online deadline is January 31st, 2025.
And if you file on paper?
That's much earlier, October 31st after the tax year ends. Most people file online now, but it's good to know both, and again, miss them, and you'll likely get an automatic penalty.
Right, and the personal allowance, the amount you earn before tax.
For the current tax year, 2024-25, that's 12,570 pounds. So your first 12,570 pounds of total income is tax-free. Understanding that is fundamental to figuring out your taxable profit.
Okay, and national insurance, just quickly recap the types again.
Sure. For sole traders, it's typically Class 2 and Class 4. Class 2 is a flat weekly rate, currently £3.45 a week, paid if your profits exceed a threshold, £6,725 for 2,425. But changes are coming to abolish mandatory Class 2 soon.
Okay.
And Class 4 is a percentage based on your profits. For 24-25, it's 6% on profits between £12,570 and £50,270, and 2% on profits above that. Both usually calculated and paid via self-assessment.
Got it. And finally, VAT, value-added tax. When does that become compulsory?
The threshold is key here. You must register for VAT if your VAT taxable turnover, that's your total sales, not profit, goes over £90,000 in any rolling 12-month period.
90,000, okay.
If you hit that, you have to register, start charging VAT on your invoices, usually 20%, and file regular VAT returns with HMRC, typically quarterly.
But you can register before you hit the threshold.
Yes, you can register voluntarily. The main reason people do this is if they buy a lot of VT-able goods or services for their business. Registering lets you reclaim that input VAT.
But it means more admin.
It does. Filing VAT returns adds to your workload, so it's a trade-off to consider.
Okay, let's pivot to tax planning strategies, making things work better for you. We know keeping receipts is vital for claiming expenses. What sort of things can freelancers typically claim?
Oh, loads, potentially. As long as the cost is wholly and exclusively for your business. Think office costs, stationery, postage. If you work from home, a portion of your utility bills, like heating, electricity, internet.
How do you work out the home office bit?
You can use simplified flat rates provided by HMRC based on hours worked at home, or calculate an actual proportion based on, say, the number of rooms used for business or time spent. Software, subscriptions, business insurance, accountancy fees.
Travel.
Business travel, yes. Train fares to meet clients. Mileage if you use your own car for business journeys, but not your regular commute. Training costs, if the course updates existing expertise related to your freelance work. Keep records.
Great, records again. We mentioned pensions helping with tax relief now. How significant is that?
It can be really significant. Effectively, the government tops up your contribution. For higher rate taxpayers, the relief is even greater. It directly reduces the amount of income you pay tax on in that year. It's one of the most effective tax planning tools available.
So worth looking into seriously. And claiming expenses, any common ones people miss.
Sometimes smaller things get overlooked. Professional body subscriptions if they're relevant. Maybe bank charges on a business account. Using your personal phone for business calls, you can claim a portion. It all adds up. Being thorough pays off.
We touched on VAT, the pro of reclaiming VAT, the con of admin, and maybe higher prices for some clients. Anything else to weigh up?
Just being aware of the different VAT schemes, like the flat rate scheme, which can sometimes simplify things for smaller businesses, although its benefits have been reduced for many. Again, it depends on your specific circumstances.
Okay. Capital allowances. Sounds technical. How does that help if you buy, say, a new computer for work?
Right. Instead of claiming the whole cost of a significant asset, like a computer or maybe some machinery, as an expense in one go, capital allowances let you deduct a portion of the cost from your profits each year over the asset's life.
Spreads the tax relief.
Yes. Although there's also the annual investment allowance, AIA, which currently lets you deduct 100% of the cost of qualifying assets up to a very generous limit, £1 million in the year you buy them. So for most freelancers' typical equipment purchases, you often get the full tax relief upfront anyway through AIA.
Oh, that's useful. And just hammering it home again. Setting aside money for the tax bill. Simple, but essential.
Absolutely fundamental.
Yes.
It avoids that horrible shock when the bill lands. Discipline yourself to do it every time you get paid. Put it somewhere you won't accidentally spend it.
And finally, tax software. We mentioned it for record keeping. How does it help with planning?
Good software doesn't just record. It helps you categorize expenses correctly, making sure you claim everything you're entitled to. Many packages also give you a running estimate of your tax liability throughout the year.
So you can see it building up.
Exactly. That really helps with budgeting and avoid surprises. Plus, it usually streamlines the process of actually preparing and filing your self-assessment return, often linking directly to HMRC, reducing errors and stress.
Fantastic. That's a really practical set of strategies. So, if we had to boil it all down, what's the absolute key takeaway for freelancers listening about UK tax planning?
I'd say it's about being proactive and organized. Don't bury your head in the sand. Understand your obligations from day one. Keep meticulous records. Honestly, it's the foundation of everything. Make sure you're claiming all the reliefs and allowances you're entitled to. And, crucially, plan for your tax bill throughout the year, not just when it's due.
Get organized, stay organized.
Yes. Doing that gives you control, reduces stress, and ultimately helps you keep more of your hard-earned money. It makes your freelance life much more sustainable financially.
Couldn't agree more. It's so clear that getting a handle on taxes is just vital for freelancers in the UK to thrive. We've covered a huge amount today, hopefully some really useful pointers there for everyone listening.
Hope so.
But remember, everyone's situation is a bit different. What works for one person might need tweaking for another. So for that really personalized advice, tailored to your specific freelance business and circumstances, reaching out to the experts is always a good idea. And the team at my tax accountant who helped put this discussion together, they really specialize in helping freelancers navigate all this stuff.
Yes, getting professional advice, especially if things feel complex or you're unsure about things like IR35 or VAT, can save you time, money, and a lot of worry in the long run.
Definitely worth considering. Thanks so much for breaking all that down today.
My pleasure.